I created a stock investing strategy that outperforms the S&P by over 2x without buying any tech stocks. This was inspired by the academic research on insider trading and value investing. I looked at over 151,000 insider trades since 2009 and found that when insiders buy the stock after a significant stock price decline, that stock significantly outperforms the S&P over the next year. The first thing we did was look at all insider buys at stocks where the price had fallen in the last month, and we looked at different thresholds, 0%, 10%, 20%, and 30%, to see if bigger dips led to better returns. And the answer was all of the stock dips lead to outperforming the S&P in the next year, and the performance improves as the dips get larger. So when the stock price was down over 30% in the last month and then insiders bought the stock, that stock gained over 50% in the following year on average. I then checked to see if this outperformance existed across both small caps and large caps, because a lot of academic research on insider trading shows that all of the alpha is only in the small cap stocks, not the large caps. This is not the case for insider dip buys. The outperformance exists across all market caps. I then looked at the 1 year time frame to see if insiders buying the stock that are way down over the last year also outperformed. I call these longer term dip buys because it's normally a much longer term, slower price decline versus the 1 month dip buys, which normally come about because of bad news like an earnings miss. The results were the same. These long term turnaround buys also outperform the S&P significantly. And the craziest part is this is basically a value investing strategy with almost no tech stocks included in the backtesting.